that this year's Milken Conference has been largely optimistic, but our executive editor, Brian Sozzi, sat down with TCW CEO Katie Koch, who said the positivity might be overstated.
One of my main takeaways is that people look a little too happy for me here. We're a little bit more pessimistic about the global outlook, and I'm struck by the fact that I think sentiment's actually still relatively positive here. We're really looking at TCW for a macro environment that's going to be pretty challenging, and so we're in the camp of having a medium to hard landing. And what I would say is that I don't think the rest of the sentiment's caught up to that view, and that makes sense because in the markets we can see a relatively sanguine expression that credit spreads haven't widened yet. We haven't seen the VIX broaden out a lot, and so my main message to you would be that our outlook is more negative going forward than probably consensus, and more people need to catch up with us, which means that we're probably going to have more volatility and more drawdowns ahead of us.
Thank you for keeping it real, because that has been one of my takeaways so far from the conference. But on the positivity aspect, what is driving that?
Our outlook, what's driving our outlook?
Well, why is everyone still so positive on markets when they see a lot of train wrecks coming right at them?
Yeah, no, that's a good question. I mean, I think the main reason for that is that it's kind of correlates to the fact that the markets haven't really started to correct aggressively yet, number one. And number two, people understand that the Fed now has firepower to cut if they need to support markets. And I think that gives people a kind of sense of confidence that things could be okay.
Do you see a rolling credit crisis? And I ask that because a lot of folks that I've talked to at the conference worried about commercial real estate, worried about the aftershocks of all these rate hikes we have had. Do you share that sentiment?
I am worried about the environment from that perspective. I mean, usually recessions are preceded by some type of credit incident. Obviously, in the last big one, that was around mortgages, and in particular residential mortgages, and then how that created systemic risk in the banking system. This one's going to look different because that was about large banks, and this one obviously is much more focused in the small and regional bank space. But people shouldn't be mistaken that somehow makes it less severe in any way. Actually, small and regional banks are very big contributors to the economy and to jobs. Just you may be aware, but about 50% of Americans are employed by small businesses. Contributes about 50% to GDP, small businesses do. And when you look at companies with 100 or fewer employees, 70% of their commercial and industrial financing comes from small and regional banks, and 30% of such financing, so small and regional banks with 250 billion or less in deposits, and 30% of such financing comes from small and regional banks with about $10 billion or less in deposits. And so the main issue is that those banks are suffering deposit outflow. Obviously, that's been reported widely in markets. And the other issue is what you pointed to around commercial real estate. These banks are actually very large holders of commercial real estate that used to be owned by big banks. It's now owned by small and regional banks, insurance companies, and some private market players. And so they have this dual pressure from both deposit outflow and their commercial real estate exposure, and that's going to put pressure on those banks. It's going to put pressure on their ability to extend credit, which in turn is going to put pressure on the economy and jobs. And so, yeah, we are quite worried about that, and that really underscores the base view as to why we're in the more bearish camp.
What ends this crisis? Is it a crisis?
I don't think we'll get to a crisis. I mean, we're going to have a recession, and just to make people feel calm about that, recessions have human impacts, and we need to acknowledge that. It's job loss, and that's obviously a very bad thing. But we also need to acknowledge that the world always moves in cycles. We've actually been in a very long expansion cycle with a short blip when we were talking to each other from our respective kitchens. But other than that, we've had a 15-year expansion. And the world does move in cycles. We are likely to head into a recession for that reason, and because we've had a lot of excess buildup. We're going to need to work our way out of it. But what I would say to you on whether or not it's a crisis is going back to the fact that the big banks, that what we call the GSIBs, the globally systemic important investment banks, those are actually highly well capitalized. And all of the regulation that we put in place in the last crisis actually should put them into a position to be able to act counter-cyclically to deal with whatever credit crunch comes. So I want to say that yes, there's a lot of pressure in small and regional banks. It will be the catalyst, that credit crunch, for this recession. But the world does move in cycles. It doesn't necessarily have to turn into a full-blown crisis. We'll have a slowdown in the economy, and hopefully we'll be able to address that slowdown through a combination of Fed action as well as counter-cyclical credit extension from the big banks.
And that was TCW CEO Katie Koch along with Yahoo Finance Executive Editor Brian Sozzi.